Good morning, everybody. It's that time of the month when we would normally be having our insight seminars down here in Howick and as well as in Joburg. We should have been in Joburg this morning. Obviously, we're not, but that's no reason why the show shouldn't go on. And so we just really wanted to summarize our thoughts on where we are in this lockdown and where we go to from here. So without further ado, we'll get started. Just to set the scene, and I think to put some things in context, we will start with a look at basically how many cases there are around the world. So if you look at the chart on the left, global daily new cases around the world is running at about 75, 80,000 cases a day. The red line is the 5-day average, which is probably more important as we go through the next couple of slides. So you can see that what is encouraging from that is obviously after a very sharp rise initially, things are leveling out, although the 5-day average has ticked up in the last couple of days. Equally so, if we look at the chart on the right, the rate of new deaths, this is also now trending at sort of 8,000 a day. The trend doesn't seem to have flattened off yet, although the daily data has come down, but the 5-day average is still high. In terms of COVID, the epicenter has obviously moved initially from China, then it was Europe in terms of Italy and Spain, and the UK, and then it moved to the US. I think what's really interesting about these two charts is if we look at the individual countries, so I've excluded China here because it distorts the chart somewhat. But what the market is looking at and what the market is focusing on is the trend in these countries to see whether these lockdown measures are working and how quickly life will get back to normal. So if you look at the chart on the left and we look at Italy, which is the light blue line to start off with, you can see a rapid rise in new cases, and then there's been a gradual softening of that trend, and the same thing is evident in Spain. What is of slight concern is that in Spain there has been an uptick over the last sort of week or so. In the US, there seems to be a sort of agreement or a broad consensus emerging that the rate of new cases is peaking. In the UK, possibly a similar thing. Obviously, the concern is that those lines are sort of ticking up slightly and that it may not peak. But on the basis of the information we have at the moment, that's how the market's interpreting it. Similarly, if you look at the rate of new deaths, and both these charts are essentially 5-day moving averages, is that you can see that the rate of mortality in Italy and Spain has come down a lot, as well in the UK and the US just starting to, which is also giving people comfort that the restrictions are working, that the healthcare systems are coping, and that essentially paints the way for some sort of return to normality. So what's the market really focusing on? What's driving sentiment? Because I think it's probably a commonly held view that markets have been much stronger than one would have anticipated over the last couple of weeks. Well, the chart on the left is really the key crux of the whole matter, is the global rate of daily new cases, expresses as obviously a percentage growth rate. And this growth rate has been falling steadily for the last couple of weeks, which is really the key issue driving sentiment and the key issue of when will economies start to relax these restrictions and when will things start to get back to normal. And the lower that growth rate goes, obviously the fewer new cases, the sooner we are going to get back to normal. The chart on the right is a little bit more concerning. It's the global mortality rate. And this is essentially the total number of cases globally divided by the total number of deaths globally divided by the total number of cases. Now, this looks extremely high at 7%, and that would be extremely concerning. The market is not focusing on this at the moment because no one really believes that this is the true mortality rate. Because the denominator of this equation is the total number of cases, and the number of cases depends on how many people are being tested, there's a general opinion that many, many more people have corona or COVID-19 than the official stats show, and that actually the mortality rate is therefore much lower. So while this is obviously a concerning chart and it might be reason for people to get concerned, um, the market is not actually subscribing much credence to it at the moment. So let's move on to the other victim. I've called it the other victim because to call it the real victim is extremely insensitive to all those people who have perished in this disaster. But the other victim is the global economy, and this is probably one of the most important slides in the whole presentation. So what I've tried to do here is show the annual forecast for GDP, which are on columns 2, 3, and 4, and then the quarterly forecast for 2020, so broken down into the 4 quarters of this year. And then the final 2 columns I'll talk about in a moment. So let's just focus on the 2020 year, which is the third column in the table, and you can see that generally the world is now forecast to go into recession. So globally, we are looking for a 4.7% contraction in global GDP over the course of this year. And you can see the breakdown: the USA minus 7.7%, the UK 8, Europe 7, and SA 7 as well. China remains positive at 1.3% growth, but obviously a far cry from the 6.5% at which it's been growing over the last 10, 15, 20 years. In 2021, there's an equally large rebound, but that's also because of the maths. If you have a very weak this year, you expect obviously a stronger rebound in the current year. So let's then move on to the quarterly forecasts. You can see the scale of the GDP contraction in quarter one. In China, it was 35%, and obviously they're 1 quarter ahead of the rest of the world. You can see in quarter two the scale of the contraction that global economists are expecting for GDP: 40%, 60% for the UK, 40% for us. These numbers are unprecedented. We wouldn't have had this sharper contraction in global GDP since World War II. Equally, as things currently stand, and assuming that countries start to come out of lockdown during May sometime, there's an equally large snapback in quarter three and then tailing off into quarter four. So quarter three is going to produce some of the strongest growth rates, but just because quarter two was so negative, and then obviously quarter four continues the positive momentum. What I think we should also then focus on is the last 2 columns of the table, which basically compares the current forecasts, which were in column 3, against the forecasts that were prevalent on the 1st of April. So generally, economic forecasts are updated by the big global economics units every week or every 2 weeks. And you can just see, even from the 1st of April to now, which is 3 weeks later, how the forecasts have been downgraded. So the global economy has gone from a contraction of 2.9% expected 3 weeks ago to a 4.7% contraction now. And every single one of those regions is worse than previously expected, except for China, which is starting to come out of its severe lockdown. So that's a real concern in terms of GDP. We won't. I suppose the other point is that by the end of 2021, global GDP will be 3.8% lower than it would have been prior to the pandemic. So there has been a permanent loss of GDP over this exercise. It's not that it won't be that we are going back to normal or to the same level as this passes. So let's just delve a little bit more into some of the economic data. It's early days, but this is an example of vehicle sales. So vehicle sales are often used as an indicator because vehicle manufacturing is a huge component of the manufacturing economy. It's a huge component of people's purchasing power, and it's probably the second biggest purchase that most households make over their lifetimes, apart from a house. And there's a huge supply chain in vehicles, all the components and everything like that. So it's a good indicator of where things sit. So all these charts are an annualized rate. So it assumes that you're selling in the US, normally they sell about 17 million cars per year. So if you look at the US, normally before the crisis it was running at about 16.8 million cars per annum. And in March, that fell down to 11.5 units on an equivalent annualized rate. In Europe, a similar contraction down to 5 million units. What's interesting is actually in China. So China is a month or 6 weeks ahead of everywhere else. They closed their economy earlier, and they're starting to come out of full lockdown at the moment. So China, this is also because of their Lunar New Year, but sales absolutely collapsed from 21, 22 million units all the way down to 4 million units. But in March, they rebounded quite strongly from sort of 4.5, 4 million units back up to 12.5, 13 million units. So that's also an indication, because China is ahead of other areas, that when restrictions are lifted, there can be a snapback in activity, which is quite encouraging. So let's just use the US as an example, and I think this is just indicative of how of what an impact the lockdowns are having. So these charts are quite small. They were taken from Macquarie Research, and we thank Macquarie for them. But they just give an example of the extent of the lack of demand in an economy. So if we just go through the 6 charts that I've got here, top left to bottom right, the first chart is US hotel occupancy rates. So normally, hotels in the US are running at 65, 70% occupied for this time of the year. Currently, that's down to 20%. You can imagine how much money hotels are losing if they've only got 20% occupancy. In terms of the number of seated diners, people going out and sitting at a restaurant having dinner, that is at zero, 100% down from where it should be. People are not allowed to go out, so it's not unexpected that it's zero, but that really highlights the extent of the collapse. The same with the next chart in terms of retail sales. Department stores, extremely hard hit, sales down 25 to 30%. Discount stores holding up better as people stock up. And the red line would then be the total or the combination of the two, but going negative. And you can see in the US, you very, very seldom get negative retail sales. If you look at the left-hand chart on the bottom row, box office gross revenues in the US. This is obviously movies, people going to the movies. You can see, and it's obviously all the equivalent years in that chart as well. This year it's at zero. Cinemas are shut. All the big movie studios have delayed releases. The new James Bond movies, the new Avengers movies, Star Wars, I think is in there. They've all been delayed and not released because theaters are closed. So box office revenues are zero at the moment. Travelers going through US airports, look at that, down almost 90, well, probably 95%. And then US rail traffic, just to end off the examples, also relative to the previous years, collapsing. So this just gives a snapshot of how broad and how damaging the lockdown can be on an economy. And it's nice to use the US because their data is a lot more comprehensive than some other countries. At the same time, China offers a little bit of hope. So we had Chinese New Year, and their lockdown coincided with that, and they didn't allow people to go back to work after the New Year. And so if you look at the chart on the left, this is daily coal consumption in terms of using coal to generate electricity, which is obviously an indicator of how fast the economy is growing. So normally you would have a real lull in coal sales over the Chinese Lunar New Year as they go on holiday. It's a bit like our December where we have a real lull in demand. And this year followed that exact same pattern. The red line followed that pattern. But it didn't, obviously the recovery didn't happen because of the lockdown. But now you can see that after 3 months, Chinese coal usage is generally back to where it was in prior years. The same thing in terms of property sales. There was a real lull during the lockdown, and it's gradually returned to sort of what would roughly call normal levels. Passenger movements is still a bit slow. It's recovering, but it's well below where it was early in the year. But this does offer some hope in that there can be a real snapback in activity once the lockdown ends. The real question is how much damage has been done in the interim. So obviously what has happened in this instance is that governments have stepped in. During the financial crisis, central banks really first started experimenting with QE and what impact that would have. 10, 12 years later, it didn't have the widespread negative impacts that people thought it would in terms of runaway inflation, for example. And so governments and central banks have been far quicker to react to this crisis than they have been to other crises in an attempt to prevent some of the systemic issues taking hold and becoming more widespread. So if you look at the chart on the left, we are back to a situation where global interest rates are zero for all countries. The US has cut interest rates to zero. The EU was always at zero, they never moved, and the UK has gone back to essentially zero as well. I mean, they're marginally above zero, but for all intents and purposes, they're at zero. On the other side of the chart, on the right-hand chart, is a chart of the US Federal Reserve's balance sheet, and this is an indication of the QE and how much the US Federal Reserve is pumping into the system. So you can see prior to the financial crisis in 2008, the Federal Reserve's total liabilities were very nominal and they hardly ever changed. Then there was a massive uptick in the financial crisis, and then it rose steadily over the next sort of 4 to 5 years as all the QE was rolled out to stimulate that economy. And then the QE was stopped, and those liabilities gradually rolled off, and the Federal Reserve didn't reinvest some of the interest on all those bonds, and so it started to taper off. And now we've hit this crisis, and you can see the scale of the money that has been thrown at the problem. And this has really calmed markets down. One of markets' big fears is that a crisis in one area can lead to crises in other areas, and there's a lack of liquidity. What you don't want is banks to stop lending, to call in loans, to get very adverse. And by the Federal Reserve and other central banks, even our own reserve banks, stepping in, making sure there's liquidity in the market, making sure that money keeps on flowing, they have prevented a wider systemic issue and a much deeper crash, which is to be applauded. So what does this mean for earnings? This is probably one of the most controversial areas because it's a forecast and opinions vary widely on the subject. But let me just explain what I mean by these two charts. So the chart on the left, they're similar charts, but the chart on the left is the S&P, and the blue line basically shows the forecast for the rate of growth and profits over the next 12 months. So if we start off with the blue line, in January, the forecast was that profits would grow by 15% over the next 12 months, from this past January to January 2021. And that forecast was pretty static until we came to March, when the crisis started to hit. And gradually forecasts have been revised down. Now we're sitting in a situation where profits are forecast to contract by 7% over the next 12 months. The red line is the next 12 months after that. So it's essentially 24 months from now. And you can see that again. So over the next 12 months, from now until April next year, profits are expected to fall by 7%. And then from the April 2021 to April 2022, they're expected to grow by 10%, by 18% as the recovery takes hold. Now, we've done the same thing for Europe, and you can see that in Europe, profits were forecast to grow by 40%. They're now down to essentially zero growth, and obviously there's been a pickup in year two growth. The big debate is whether these earnings revisions are accurate, I suppose. It's not to say they're inaccurate, but we believe that the risk is that they fall further based on the chart that we've just shown you in terms of how much damage is being done to the real economy. What we didn't show you in some of the charts was the change in unemployment in America. So America has a scheme called an initial jobless claims. So if you become unemployed, you can go and file for unemployment benefit. Normally, during the financial crisis, at the worst of the financial crisis, initial jobless claims, so those people filing for unemployment benefit for the first time, was running at about 650 to 700,000 people per week. The last 3 weeks, that number has been roughly 6 million people per week. So the unemployment rate is going to surge in America. probably well past where it was in the financial crisis. So the risk on both these charts in front of you now is that earnings still have to decline further, uh, depending on how long the crisis lasts and how quickly economies get back to speed. Apologies, I went the wrong way. So what are markets pricing in? So let's look at valuations now and just get a sense of where valuations are. The chart on the left shows the PE ratio for the S&P 500 index. And you can see that before the crisis, it was trading at about 22 times. And then at the worst, in that first couple of weeks, which bottomed on the 23rd of March, the PE fell all the way to about 15 times. And based on the current level of earnings 12 months forward, which I showed you on the previous slide, those two little dots marked F are the forecasts of where the PE will be if the index stays exactly the same from now and those expectations come to pass. So in a year's time, if the index stays flat and profits fall by 7%, the PE will be 20, and then in a year further on after that, the PE will drop to about 17 times. Now, we don't think that that's particularly cheap given the scale of the crisis. So the risk is that the earnings fall a bit further and those valuations rise a little bit further, which then essentially, given where we are in the cycle and the stress that economies are under, is not particularly compelling. But you must look back at 2009 when the PE ratio really spiked. So when you have a drop in earnings, obviously markets are forward looking. So you can have a drop in earnings and the PE can rise to very high levels. But if there's a recovery projected on the other side and it's projected to fall just as quickly, markets will look through that and say, we know there is a collapse in earnings coming, but we're confident that there's an equal recovery coming, and we are going to look through the collapse and into the recovery. And that's really what's been happening over the last couple of weeks. So the same thing in Europe. European shares look a little bit cheaper. Um, a forward PE of 15 in 12 months' time and about 12 and a half in 24 months' time. So Europe does look a little bit cheaper, but probably with good reason. So what are the implications for South Africa out of all of this? Let's start off by acknowledging that we were already in recession prior to this crisis. Unfortunately, we already had 2 quarters of negative growth, and we were technically in recession. There's no doubt that growth will collapse in 2020. As I showed in the previous slide where I had the table, South African GDP growth is expected to be minus 7% this year and recovering into 2021. But we are going to have a deep recession in this country too. Unfortunately, the difference between developed markets and emerging markets is going to become quite apparent during this crisis. We do not have the fiscal depth to stimulate to the same extent that developed countries do. We don't have the tax revenue, we don't have the budget capability. We've already used all our surpluses. So we have taken action where possible. Interest rates have been cut 3 times this year, which is shown on the chart on the left. The repo rate is now at 4.25%. It's been cut by 2.25% over the course of this year. And to be fair to the Reserve Bank, this is the most aggressive they've probably ever been in our lifetimes, and it's welcomed. We do agree with the Reserve Bank that low interest rates are not going to solve all South Africa's problems. We need structural reforms, but at the margin, low interest rates help. They help to keep bad debts under control. They help companies to borrow. They help to keep money turning in the system and to keep the economy afloat. There's obviously various government initiatives to help the affected, but generally they're probably too small to really prevent our economy from having a deep recession. In America and in Europe, they're much better equipped to disperse money and especially to unemployed, and to keep the economy ticking over without it falling into a cliff, which we don't really have the ability to do. And there's obviously been a lot of private sector contributions from a lot of different companies as well. As I say this and record this video, we had an announcement that Cyril Ramaphosa will address the nation tonight, Tuesday the don't even know what that is, 21st of April. So we might have some more feedback tonight. But generally, the stimulus that we are able to direct to our economy is it's welcome, but it's not going to be sufficient to prevent us from having a deep recession. Obviously, COVID has also coincided with the inevitable downgrade of our sovereign debt rating by Moody's 2 or 3 weeks ago. So that wasn't unexpected, but it's almost been overshadowed by COVID and happened. So the pace of recovery into 2021 is really going to depend on whether reform is accelerated or not, and whether the government use this crisis to actually push through the reforms which we desperately need. Because if they do, confidence will build as we come out of this crisis. If they don't, you're not going to have that confidence, and we're going to languish at a very low level, in our opinion. So foreign sentiment remains poor. We show these charts quite often, but I think it's useful to have an update, especially in light of the sovereign downgrade that we had as well. Foreign transactions, this is foreign investors buying into the bond market and into the JSE. You can see from the blue line that with equities, and this is just for this year alone, there's a steady net selling of equities by foreigners. The bond market is a little bit more interesting. The bond market, there was an inflow in the beginning of the year. Then there was a massive outflow of about 55 billion rand in March alone, as people, or over February and March, as people got nervous, as foreigners got nervous ahead of the budget, and then ahead of potentially a sovereign downgrade. And over the last couple of weeks, that the bond market has actually turned slightly positive, and foreigners are coming back into the bond market. So if you look at the chart on the right, this is the yield to maturity on the R186 government bond. You can see the massive spike up to 11.5% when the sovereign downgrade was announced, and the bond markets come right back. First of all, the Reserve Bank did step in, and we have launched our own version of QE. It's very small, but the Reserve Bank did step in and say that they are going to be buying bonds. And that was a reaction to the fact that there was pressure on the bond market from the lockdown, and it coincided with the Moody's downgrade. So the Reserve Bank did the right thing. They stabilized sentiment, they provided a backstop, they provided liquidity, and it gave the market a chance to settle down. And bond yields have come right back, and actually this morning they were trading very near the 9% or slightly below the 9% level. So the Rand, where does that leave us on the Rand? The Rand is very weak. There's lots of charts that I can show on the Rand, but I've only chosen to show one here. The Rand is behaving like it always does during times of crisis, and like every other emerging market currency. We're very much in the same boat as our peer currencies, the Turkish lira, the Brazilian real, the Russian ruble. We're all relatively in a similar boat. But generally speaking, the Rand is in extreme levels of weakness. So this chart basically shows the spread of the current exchange rate over the 200-day moving average. And you can see when it got to this extreme points that there was a snapback in the Rand thereafter. So previous issues were the World Trade Center attacks, the financial crisis, Gate, and we're back at those extreme levels. So what this basically means is that the Rand, if it's currently trading at about 19 Rand to the dollar, really should be, to get back to a sort of zero line, round about 15 Rand 50 to the dollar. So the Rand is at extreme levels. History always suggests that extreme levels don't last, and that there's a snapback in the currency, and that's a risk and an opportunity for SA investors. So let's just look at the JSE. The JSE is in the middle of the pack. I think it's just sometimes worthwhile to put these charts up, to put a little bit of context into it, because we tend to focus on our own market. But if you look at the performance of the JSE since the start of the year, very much in line with what the UK and Europe has done. The US has been the best performing market by a long way, but the JSE is just performing in line with global trends at the moment. Fortunately, markets are starting to calm down. So this chart, which we did put in our Intuition, the last issue of Intuition that we did, is basically the daily volatility. So all the little blue bars is the daily percentage move in the market since the start of the year. And you can see that in January, the daily percentage moves were quite small. The market was quite calm. In February, they got a little bit bigger. Everybody was looking towards the budget at the end of the month and getting a little bit nervous for what might come. In fact, the budget was a pleasant surprise, and that was a positive event. But then you can see toward the last few days in February that that's when the COVID virus really started to take hold around the world, and the volatility started to increase. And then into March, where we really had massive daily swings in the market each day. So we had many days where the market was down 6, 7, 8%. And as we got towards the end of the month, we had quite a few days where the market was up 4, 5, 6% as well. So you can see the swings in both directions. It wasn't just a one-way trip down, there were equally big moves on the way up. And if you look at what's happened in April so far, the dotted red lines basically show essentially the level of volatility. So the level of volatility is narrowing, the market movements on a daily basis are getting less extreme, which is good. It means that markets are calming down. But what's probably equally encouraging is that there are probably more up days than down days, but there are still some quite wild swings. So the volatility is still a lot higher than it was in January or February, but it is starting to calm down, which means that markets are starting to assess, investors are starting to assess what's going on, that herd mentality is abating, and you're assessing individual companies, individual shares on their own merits as opposed to sort of herd running from one side of the ship to the other. So earnings and dividends, this is the crux of the storm for us. So these are historical charts just showing sectoral earnings growth and sectoral dividend growth for the three main sectors of the JSE: resources, financials, and industrials. Now let's just focus on earnings. The light little blue line, that was already negative going into this crisis. So industrial earnings were already growing negatively, and that's not surprising given where we find the economy. The resources sector was positive and financials were marginally positive, but that's also partly because of insurance companies and the fact that 2019 was a better year for them in terms of investment performance. It's probably fair to say that financial and industrial earnings were already negative going into this crisis. Resources were holding up. Looking ahead, we expect earnings to be hard hit. There's no way to get around that. There will be some relief. The weakness of the rand is going to cushion those companies with foreign earnings. It's also going to cushion especially mining companies where commodity prices have actually held up pretty well. But in some cases, mining companies aren't mining. So there is going to be a hit on earnings on that. On financial and industrial companies, we do expect earnings to go sharply negative. That would then feed through to dividends. We've already talked about dividends in our Intuition newsletter, but we expect a real dividend drought over the next year. A lot of companies are under pressure. Well, companies that are regulated are under pressure not to pay dividends. The banks and the insurance companies have been asked by the regulators not to pay dividends to make sure that they keep their capital intact, to make sure that there's no systemic risk to the banking system. That makes sense. It's a prudent approach, and all the banks have indicated that they're going to follow that approach and that advice from the Reserve Bank. So one of the highest paying dividend sectors on the JSE, where banks are yielding between 7 and 10%, are not going to pay dividends over the course of 2020. Industrial companies will be much more case-by-case basis. There will be some companies that will continue to pay dividends regardless, and there will be other companies where the balance sheets are weaker and they won't be able to. That is really on a case-by-case basis. The same goes with mining companies. We think that mining companies generally will pay a little bit, especially the big diversified mining companies like Billiton and Anglo. The individual companies, the individual miners, the platinums and the golds will again be a more case-by-case basis. And obviously Sasol had already waived its dividend for the next 2 years prior to this crisis as it tries to rebuild its balance sheet. So we really, really do expect that dividend growth is going to probably fall by 50 or 60% over the course of this year. The weaker rand again will help because some companies on the JSE do get foreign foreign earnings, and that's being translated at a significantly weaker exchange rate. So there will be some relief on that. But on the whole, we're going to have 2020 might be the year that's remembered as the dividend drought. But having said all that, valuations are attractive. So this is a chart of the JSE all-share PE ratio. You can see that this goes back for the last 20 years. At the end of March, the PE ratio really got down to sort of the lower level of the band, or one standard deviation. It's bounced back a little bit in April, as the market has bounced back in April. We expect obviously earnings to fall and therefore the valuation to rise. So valuations, the PE ratio will rise, and it will probably rise to the top end of the range, back to 18 or 19, because earnings are falling. But actually, if you take Naspers out of this equation, because Naspers is included here, and Naspers has actually been one of the best performing shares on the market this year, the PE for the rest of the market is close to 10, which is extremely cheap. So as bad as the news is, a lot of that bad news is already factored into the price. And that's really the difficulty with markets at the moment, is that you're trying to gauge how much bad news is already reflected in the price and where to from here. The news can continue to be bad and the earnings reports can continue to be poor, but to a large extent, we think that's already reflected in the price. It's not to say markets can't go a little bit lower, but a lot of the bad news is already reflected in the price. Just to touch very quickly on listed property, there's a disconnect in the listed property market relative to bond yields. So if you think back to the chart that I showed on the R186 bond yield, which spiked to 11.5% when we had our sovereign downgrade, and it's come all the way back to sort of 9%. Listed property has been extremely weak. We know that. Normally, the income that you get from listed property is less than the equivalent bond yield. You can see that in the chart. It's normally quartered between 0 and 2% less, maybe on average 1.5% less. And that is because listed property has the ability to have a growing income, and therefore you pay a premium for that. What's happened in the last 2 years is that premium to government bonds has evaporated and turned into a massive discount. So now you can get on average 6 or 7% more in listed property as an income yield than you can on a government bond. And that is a reflection of the fact that listed property is in crisis. Retailers are not typically wanting to pay their rents, and the economy is slowing down. As we come out of lockdown and as things normalize, we expect this disconnect to gradually repair itself and to narrow, but it will take time. But listed property really does offer some extremely good value for the patient investor at the moment, although it might take 12 to 18 months for that value to start to become apparent. So how are we positioning in these tough times? We are bracing for more volatility. Markets have had a good run since the 23rd of March. We've been surprised at how firm markets have been, especially globally, and the global sentiment is really driving the local sentiment as well. We expect more volatility. At the moment, the market is anticipating that the lockdowns will be over quite soon and that life will return to normal. What none of us can ascertain at the moment is the extent of the damage that's being done and how quickly things will get back to normal. How many businesses are going to close forever? How quickly will the unemployment rate fall again? So in that respect, one must be more bullish on overseas markets because they have more tools at their disposal to cushion the blow for people who have been laid off, which we don't. So previously, we favored what's called a barbell strategy in terms of having offshore rand hedges on the one side and local shares. And we would have preferred the offshore rand hedges to the local shares, sort of in a 60-40 or a 70-30 kind of split. In our previous presentations, we made the case for moving to a more equal split, 50-50, on the basis that while SA growth for 2020 would still be weak, SA markets could start to perform better as reforms continued and sentiment started to improve in this country. That view has to be challenged in light of what's now happened. So our current view is that the pace of normalization across the globe is unclear, and we are concerned that earnings still need to fall to reflect a deeper contraction. And so the risk to markets is that those earnings growth forecasts that I showed earlier fall further, and this weighs on sentiment and markets give up some of their recent gains. I'm not sure we're going back to the lows that we reached on the March the 23rd, but some of the froth, if you can call it that, in markets at the moment might just come out a little bit. So near term, we expect some more volatility. We don't think that it's all just back to the races at the moment. Medium term, developed economies, the US, Europe, the UK, will recover more quickly than emerging markets because they have the ability to throw more money at the problem, literally. They have the depth and the scale to stimulate their economies and to come out of this crisis quicker than emerging markets do. It's just unfortunately a fact of life. So SA growth will languish, especially if we have a phased reduction from lockdown. So as I said, President Ramaphosa is talking tonight. We might get some sort of feeling on the government's feelings about our lockdown. Last week, when they did a big presentation, they were saying that if daily cases are above sort of 145 or 150, that the lockdown would continue. We are concerned that daily cases are above 150 per day at the moment, but we are very much hoping that there will be a phased reduction in the lockdown to take account of the enormous economic damage that's being done at the moment. But SA growth is going to languish. There's no doubt that even as we come out of this lockdown, it won't be completely business as normal. There probably still won't be large gatherings and things like that. So while economic activity will normalize, it's not going to be completely as it was in December or January of this year. So on that basis, offshore markets are likely to perform better in the short term, given their ability to stimulate and to cushion the unemployment crisis. And that essentially implies that we should return to a barbell strategy in favor of offshore rand hedges. So to go back to that sort of 70-30 split where we have rand hedges in the portfolio with a little bit of domestic, and the rand hedges can obviously be the mining stocks, the big industrial rand hedges like British American Tobacco, Anheuser-Busch, Richemont, Mondi, Bidcorp, and then other products listed on the JSE like exchange traded funds that track the US markets or the European markets or something like that, and obviously some of the offshore property. So what are the risks to us being underweight SA? We've quite long championed the fact that we're turning a little bit more positive on South Africa. What are the risks? The risk is that reform is actually accelerated and that the government uses this crisis to actually push through some reforms. They have no other option, quite frankly, but whether they acknowledge that and take the bull by the horns remains to be seen. If they use this crisis and push through some reforms, whether it's about SAA, SA Express, whether it's about curbing government wages, which they're already trying to do. They've given the telecoms companies some emergency spectrum over the last couple of weeks, and whether that's a precursor to them auctioning the spectrum finally and getting that sector of the economy going. If they push through some reforms and get things going, confidence from the business sector will recover more quickly than if they don't. The other risk is that the rand strengthens from these very overbought levels. The rand can stay weak for a while if emerging markets stay weak, but the risk is that where the rand is at the moment, and given that it's generally at pretty extreme levels, is that when the crisis dies down and risk appetite returns, we have a flow of money back into emerging markets, the rand recovers, and then rand hedges actually don't perform very well under that scenario. So it's not without its risks. That's why we will continue to have a barbell strategy, and we will continue to manage it within that framework of focusing on good quality companies that are going to see this crisis through. Unfortunately, we do feel that the economic damage being done globally is more long-lasting than what is currently being priced into markets. We do anticipate a recovery. We do think things will recover, but it might just take a little bit longer than what the market is expecting. On that note, I can't even throw it open to questions, so I'm getting off lightly. But we hope that you've enjoyed it. We look forward to interacting with you more. We're keeping fingers crossed that we are going to be out of the lockdown or a partial lockdown by the end of next week, and that life can gradually return to normal. In the meanwhile, take care, stay safe, and please give us a call if you want to chat through anything. Thank you very much.